James spent 3 weekends last spring inside car dealerships, and he came home from every one of them more confused than when he arrived. Not because the salespeople were unhelpful, they were enthusiastic. The problem was that every conversation kept circling back to one number, the monthly payment, while avoiding the only number that actually mattered, the total amount of money James would spend over the next several years to get from one place to another. He was looking at a $40,000 SUV. The buy option came with a 6-year loan at current rates. The lease option came with lower monthly payments, a smaller upfront cost, and the appeal of a new vehicle every 3 years. Both options sounded manageable. Neither salesperson offered to show James the complete cost picture, all the money across all the years, including everything after the payment itself. This video is that complete picture, not the monthly payment, the total reality. The monthly payment is the most effective piece of financial theater in the car buying process. It takes a large number and makes it feel small by spreading it across time. A $50,000 vehicle sounds expensive. The same vehicle at $750 per month sounds manageable. The math describes the same transaction. The psychology is entirely different. The problem with evaluating a car by its monthly payment is that the payment only captures one dimension of cost, the loan repayment. It says nothing about insurance, which runs between $150 and $200 monthly on a new vehicle. It says nothing about fuel, which on a typical SUV across 15,000 annual miles amounts to roughly $200 monthly at current prices. It says nothing about maintenance, registration, and the silent but relentless cost of depreciation. When you add every cost of ownership together, loan payment, insurance, fuel, maintenance, registration, the true monthly cost of a new $40,000 vehicle commonly runs between $1,200 and $1,400, not the $750 the dealership advertises, nearly twice that. Any honest comparison between buying and leasing has to start from that complete number, not the payment alone. The full cost of buying. Let us build the complete picture for purchasing a $40,000 vehicle using a 20% down payment, a 72-month loan at current average rates near 6.5%, and realistic ownership costs across the full 6-year period. The down payment is $8,000, committed immediately. The monthly loan payment runs approximately $535. Over 72 months, the total loan payments reach just under $39,000, of which roughly $6,500 is pure interest paid to the lender for the convenience of not paying up front. Add insurance across 6 years, approximately $10,500, fuel across 6 years at a modest estimate, roughly $12,000, maintenance across 6 years, approximately $7,000 in scheduled service, tires, and incidental repairs. Total money out, roughly $76,000. But the vehicle does not disappear at the end. A well-chosen model with strong resale value, a Toyota or Honda in this segment, retains approximately 65 to 70% of its value after 6 years, meaning you can sell it for roughly $26,000 to $28,000. Subtract that from the total cost, and the true 6-year cost of ownership lands around $48,000 to $50,000. Annual cost, approximately $8,000 to $8,500 per year to own and operate the vehicle. The full cost of leasing. Now, the lease. Same vehicle, same 6-year window, but structured as 2 consecutive 3-year leases, which is how most people who choose leasing actually operate. Each lease requires a signing payment, call it $3,500 to $4,000 per lease. 2 leases across 6 years means roughly $7,000 to $8,000 in upfront costs, similar to the purchase down payment. Monthly lease payments on a $40,000 vehicle typically run $400 to $450, meaningfully lower than the purchase payment. Total lease payments across 6 years, $32,000 to $33,000. Add the same insurance costs, $10,500, same fuel, $12,000. Maintenance on leased vehicles is typically included or minimal in years 1 through 3 per lease, so approximately half the maintenance cost of ownership, roughly $3,000 to $4,000 across 6 years. Total money out, approximately $65,000 to $68,000. Here is the critical difference. At the end of 6 years of leasing, the vehicle goes back. There is no asset, no resale value, no equity. The $65,000 is entirely gone. Compare that to buying, where the $50,000 in true cost left you with a vehicle worth $26,000 to $28,000. The lease costs approximately $15,000 to $18,000 more across the same 6-year period for the same vehicle, with nothing to show at the end. Annual cost of leasing, approximately $11,000 per year versus $8,000 for buying. That gap is real and it compounds. The numbers above favor buying clearly for a 6-year window with a well-chosen vehicle. But 3 specific circumstances shift the calculation enough to change the honest answer. The first is driving above average mileage. Standard leases limit annual mileage to 10 or 12,000 miles. Excess mileage is charged at 15 to 25 cents per mile at return. A driver covering 18,000 miles annually would owe roughly $1,500 to $3,700 in excess mileage penalties per lease, $6,000 to $7,000 additional dollars across 6 years. This single factor can eliminate the lease payment advantage entirely, and then some. The second is short-term ownership intentions. If James knows with certainty he will want a different vehicle in 3 years, not 6, the buying calculation changes significantly. Selling a vehicle at the 3-year mark means absorbing heavier depreciation relative to time owned, and the cost comparison tightens considerably. With a fast depreciating model, leasing can actually be cheaper on a 3-year window. With a slow depreciating model, like a Toyota RAV4, buying still edges ahead, but narrowly. The third is interest rate environment. At current rates, near 6.5%, the interest cost on a purchase loan is meaningful. If rates fell to 4 or 4.5%, the gap narrows, and for someone who genuinely will not keep the vehicle long, leasing becomes more competitive. The numbers tell most of the story, but not all of it. There are legitimate reasons some people should lease, even when the cost is higher. Business use is the clearest one. Lease payments on a vehicle used for business are often fully or partially deductible as a business expense. The tax treatment can close or eliminate the cost gap entirely for a self-employed person or business owner. Professional image requirements represent another. A consultant, agent, or client-facing professional who genuinely needs to arrive in a recent model may find the incremental cost of leasing to be a genuine business investment rather than a pure lifestyle expense. And personal preference for newer vehicles with full warranty coverage is a legitimate value judgment, not a financial mistake, as long as it is made consciously with the cost premium understood. James eventually bought a 3-year-old certified pre-owned version of the same model he had been looking at new, purchased with minimal financing at a price 30% below the new vehicle sticker, absorbing none of the first-year depreciation that new buyers fund for the eventual used market. The monthly payment was lower than either the buy or lease options for the new vehicle, the insurance was lower, the total cost picture was considerably better. It was, as James described it afterward, the least exciting option in the showroom, and by a significant margin, the most financially rational one. The choice between buying and leasing is not a moral question, it is a math question. And the math only gives you an honest answer when you include every number, not just the one the salesperson writes on the worksheet at the start of the conversation. Run the full calculation, then decide.